Hey there, my name is Linda Keith. I am the Chief Credit Trainer with Lenders Online Training, joined today by David Stauffacher, our Senior Credit Trainer. Hello, David.
Hello, everybody.
Good to see you. So this is a series on K-1s and pass-throughs because that's one of the most common questions we get. And it's the biggest area of confusion really for the students, the participants in our Lenders Online Training on tax return analysis and financial statement analysis. Today, we are covering the 1065 K-1 cash flow, the actual cash flow, which lines count out of the 20, 30, I don't even know how many possible lines are on there, but really 3 are essential to get to actual cash flow to an owner from that 1065 filing entity, which could be a partnership, could be an LLC. So we want the actual cash flow, what do owners actually get paid? If you had their checkbook, what would you see coming from the K-1s? So David, really only 3 lines out of however many. Which ones are those, and why do we not even care about the rest of them?
That's right, Linda. 3 lines, only 3. The 3 that we really focus on are guaranteed payments. You'll see that in the boxes there. Withdrawals, sometimes considered distributions, however, the context you explain that. And then capital contributions need to be considered because that is kind of money going into the company. So we need to be considered that. So let's start with the first line, guaranteed payments. We've had a live stream on this. We talked about guaranteed payments. Are they agreed? Generally, they're agreed, but they're not guaranteed. I think that's the misnomer of things. They're not guaranteed. Now, maybe how much they get paid based on how much they maybe work, what some of their compensation is. Maybe it's their level of expertise. Somehow they get recognized for their involvement in the company, regardless of profitability at this stage. So they get recognized for that. That's why they come up with guarantees. Now, each year they may change, so we need to be aware of that. Maybe as their kids grow up or as their family, maybe they don't need as much money out of the company as generally, so they won't necessarily provide that type of monies as well. Or maybe their kids work in the company and how much money that they would want to be able to take out of the company. So think about historical personal cash flow. We use it, but projected, we look at history from one perspective, and then we need to ask questions of what's going forward. We know they took the money out of the company historically, but is it going to happen next year? Because remember, Dave said they're not guaranteed. So
do you mean that the IRS is using words that mean something different than the way the regular people use them?
I would hope so. It is confusing in the sense that there's been several times in a variety of these live streams where we talk about certain phrases that the IRS uses that we then rename for our learners so that it's easier for them to understand, that it's probably practical for them to understand.
Yep. So in our classes, we actually say mentally cross off the word guaranteed, change it to agreed. That's what it is. It's not guaranteed.
Yeah. So where do we find guaranteed payments? Well, it's easy to find on the K-1. I believe it's box number 4, somewhere up on the top, but it's not necessarily visible in the 1040. It's actually mixed in the back of the 1040 into the Schedule E. But the main thing to remember is that in most cases, these guaranteed payments are not guaranteed, but they do represent cash to the owner. So we just kind of need to be aware of that going forward. Linda, what's next?
Yeah, well, that's probably why we get 2 or 3 years, right? As we actually look and see what they've been getting paid. So guaranteed payments is one of them, separated out in addition to guaranteed payments, which, by the way, regular guaranteed payments just aren't even there. It may just be distributions. So you have to look both places. Distributions, also called withdrawals, actually shows up in 2 places on that 1065 K-1. It shows up in box 11 down below, where we start with their basis plus any capital contributions they make minus any distributions they take to get their ending amount of capital. Or it also can be on line 19. Line 19, I think it's even called distributions, code of A. And those 2 numbers should be the same number. So if they aren't, I kind of have a question about that. But here is where I think some folks are missing a little bit of a boat. And this falls along. We talk a lot in these live streams, David, about guidelines versus hard and fast rules. we always do this, or we always do this, and notice if there's something else. So this is one of those notice if there is something else, because distributions code of A means cash. Distributions with a code of C means property, not cash. And this is where we can have a legitimate difference of opinion. Some of you are going to say, yeah, but Linda, we're only looking for cash flow, not property. We will never use the code of C, but we would use the code of A. That's the only one we will use. But here's another way to look at it, which, as you know by now, if you follow me at all, I'm always looking at the other way to look at it, because I want you to understand what is there and what might be possible. So let's say that you've got someone who takes a distribution every year of a certain amount. This particular year, golly, we have that truck we're not using anymore in the business. I could use a truck. So why don't I just take the truck and then I'll take the rest of it in cash this year? If you had all 3 years, and if you added A and C together, they were the same. In other words, if they took the property in lieu of cash, if the liquidity was such that they could have taken cash, then maybe projecting that going forward they can take the cash, even though that 1 year it was a mix of cash and property, might be reasonable. So while we don't usually use code of C, while your guidelines probably say code of A, you might encourage your lenders to at least notice if there's property and consider whether that's really just in lieu of cash, and they might want to include it in their thinking as well. One more thought before I pitch it back to you, David. I've regularly had senior lenders say things to me like, Linda, you're always looking for these digging for dollars things, right? It's like, why can't we just use code A, assume C won't be very often, but really, if we have to dig this hard for dollars, maybe it's not a good enough deal for us. I'm not going to disagree with you, but what I am going to say is this. I would rather people see the possibility and decide not to use it than to decline a loan because they did not even see this possibility. So I'm not suggesting we should just dig for dollars till our fingers are bleeding, right? But I am saying we don't want to miss opportunities for our borrower or our financial institution because we just did not notice things. So I'm on the team of let's notice possible compensating factors. Let's notice some things that might work for us and make an informed decision about whether to use it, rather than have this hard and fast rule that never can we stray from, that might have us turning down some darn good loans. That's all. All right. So let's see. Capital contributed. I guess that's our third one. Yeah, David?
This is our third one. Capital contributions. This is box L. Now, we have to be careful on this. The extent that they actually put money back into the company, you would think that would be an automatically deduct out of cash flow. Makes sense. But I want us to make caution as to our thought processes. Do they do this every year? If they do, that might lead us to assume that something else might be more concerning, that the owner is putting more money back in. Is there a reason? I at least want to understand that. However, before I subtract it, I want to make sure how this happens on a regular basis is going forward. There could be specific uses for it. We can understand that. And if so, we're going to document it, right? This may be digging for dollars, or at least making the story understand realistically how some of our small businesses, our high valued net worth owners of businesses, how that cash moves back and forth if they need it for a specific purpose. Okay, let's understand that and make an adjustment for it. Now, we talked about in one of our live streams about historical versus projected cash flow. If you're doing a historical cash flow analysis, you're going to subtract the cash flow contributions because the money actually is a deduct. It went out of their personal cash flow. It happened. But for projected, that's where we want to get our thought process to go a little bit further to say, do we understand the reasoning? Does it make sense? Is there a reason for that? And as always, document, and support why we made that decision to do so for that client. So there you have it. 3 lines on the 1065 K-1, plus there's a possibility of some property distributions, as Linda mentioned, and regards of cash as an alternative. In another live stream, we talked about the 1121 and those K items, not quite 3 items, actually that one for that case. So once you have it, these things can be confusing when you're dealing with pass-through entities. We hope that these conversations kind of put things at ease. We're having to basically answer some of them, focus on some of the challenges that we may have, sometimes misinterpretations. We want to make sure that you feel good about what you're looking at with these pass-through entities because they can be confusing. Now, some of these questions have come up because they're questions that you've asked of it. We love your questions. We love your comments. Those comments, we always like to share them send it to experts@lendersonlinetraining.com. Or you can go to our website, look at our lendersonlinetraining.com/ask-the-experts. Ask your questions there. Linda or myself will answer all your questions, or maybe we will use the content for one of the questions here in our live streams. Anything else, Linda?
Yeah, the Ask the Experts is also this email service that we have. So in addition to listening to the live streams here, if you sign up at Ask the Experts, you will get a weekly email. It is a question that was asked that week. It is a question we answered to the person directly, but if we think it has a more general use, we will create, it's basically a blog post answering the question. We send the email out to our list that just has in the subject line the question. So if you sign up for this, you get it from us once a week. You look at the subject line, you say to yourself, oh, that's what I need. Click through. If you don't need it, just delete it. If you don't need it, but somebody else on your team does, send it to them. And you, of course, it's a subscription, so you always could unsubscribe. But we call this the drip method of learning, both the live streams and these Ask the Experts. When you've got your foundation, then let's keep it going with learning more things as you go along. We think that's very valuable. It turns out that a bunch of the people that are signed up for Ask the Experts and watching these live streams think that also. That's it for today. See you next week. Thanks, David.
Bye-bye.